Hey, my name is Connor, and welcome to Crypto Empire, where we dominate the crypto markets. In this video, I'll be breaking down what DeFi 3.0 is, and it's exactly what it does sound like. It's the third iteration of decentralized finance and how users actually go about earning yield with these DeFi protocols. And then I'll be sharing with you the top most popular DeFi 3.0 protocol. So if that does interest you, be sure to stick with me until the very end of this video. And if you are new to Crypto Empire, go ahead right now and smash that subscribe button down below and turn on all bell notifications so you don't miss any future videos. And let the gains be with you. So decentralized finance took off in the summer of 2020, and that put DeFi on everybody's radar. And DeFi started off as obviously DeFi 1.0, and these are going to be the main DeFi protocols such as Uniswap, the decentralized exchange, which we're on right now. You can see on my screen, Aave, Compound, Maker, etc., Curve Finance as well. These are DeFi 1.0 protocols, and basically it is user-owned liquidity. So what I can do here on Uniswap is I can come on over here to pool, and I can actually go ahead and I can pool liquidity between two assets, two ERC20 tokens. That can be Ethereum and Aave, for example, right? So I'll add this liquidity to the Uniswap liquidity pool. This is used for the automated market maker. And what I would actually earn is the fee, right? I would earn a percentage of the fees here. And I'll also be rewarded with Uniswap tokens, with the protocol specific token for providing liquidity on that specific protocol. So that's DeFi 1.0, and this has a lot of faults to it, mainly because a lot of people simply add liquidity just to earn yield, and it's called mercenary liquidity, right? They'll just hunt for the best place to add their liquidity, earn the yield farm for a short amount of time while the returns are good, then they'll pull their liquidity and go to the next project, right? Mercenary liquidity, makes sense. So this has problems because projects become very illiquid after their liquidity provider rewards run out, all right? So that's DeFi 1.0, user-owned liquidity. Now we have the second iteration, which really took off kind of over the summertime of 2021, and that is with rebasing DAOs. So if you haven't watched my video about rebasing DAOs, Olympus DAO, Wonderland Time, I have a full tutorial. Basically, it's very simple. You buy the rebasing DAO token either from the treasury via a bond, or you can buy it directly from a decentralized exchange. And then you go ahead and stake the token, and basically the protocol owns the liquidity, right? They have a treasury, and then that's how they actually go about issuing new Time or Olympus DAO tokens. Spartacus, WAGME on Harmony One, right? There's a ton of rebasing DAOs nowadays. I'm sure you've heard about it. If you want to learn more about DeFi 2.0 and how it works, watch my video on it, right? I'll leave a card here. Nonetheless, DeFi 2.0 was a huge revolution, and these protocols are still used. I'm still staking my Wonderland Time. Nonetheless, we have a new iteration of DeFi nowadays, and that is called DeFi 3.0, and the main thing behind DeFi 3.0 is something called farming as a service, okay? And the main coin doing this, or the main blue chip most popular coin, is going to be multi-chain capital, all right? And what I mean by farming as a service is we can see right here, you buy MCC on Ethereum or Binance Smart Chain, they have it on both, and they go ahead and farm on multiple chains and return the profits to the holders in the form of something called reflections. And these reflections are very simple how they work. Basically, after you go ahead and buy MCC, you're automatically given tokens, and these are the reflections because there's a buy tax. When you buy MCC from Ethereum or PancakeSwap, Ethereum you use Uniswap, there's a 10%, they actually just changed it to 8% recently, or they're changing it to 8% tax when you buy. And this is actually distributed amongst all the MCC holders. All right, so you basically earn passive yield, passive income just for holding MCC in your wallet. All right, now let me go ahead and show you the MCC dashboard and describe further how DeFi 3.0 farming as a service protocols do actually work. So right now, multi-chain capital has $11.1 million in assets under management, AUM. All right, and it's split up among different blockchain networks. They're all EVM compatible blockchains. As you can see, it's on Phantom, ETH, Avalanche, Polygon, and the Binance Smart Chain. The respective amounts of the capital are on each blockchain, and you can see Phantom is overwhelmingly the leader with $8.2 million, almost $8.3 million, being put to work yield farming on Phantom, right? So this is farming as a service. Basically, what they're doing is they're using the amount in the treasury. So I talked to you about the buy tax. There's also a sell tax also was 10%. They're changing it to 8%. Nonetheless, every time you go to sell your MCC on PancakeSwap or Uniswap, you're hit with the sell tax, 8%, right? So if you sell $100,000 worth, you're only going to receive $92,000 of value. That $8,000 will go to the treasury, the MCC treasury, and they actually go ahead and use these funds, put them to work on all these different blockchains, earn yield, and then they do something called a buyback, right? So they'll go to the open market and they'll go ahead and buy back MCC, and then they'll either burn it or add it as liquidity so the project stays liquid on these decentralized exchanges. It's a very good idea in theory. It largely depends on the team who is running the show behind the project, because they're obviously actively managing these wallets, right? So there needs to be obviously players with ethics that are running these projects. But MCC did have a bit of a turbulent start. This is the third iteration of MCC. It's a 3.0 contract, because they want to make it hyper deflationary, right? When it first started, it was actually hyperinflationary. Then they came out with the second iteration of the token, had a bit of a problem with that, right? I'm not going to be getting into fully what the problems were, but just know that the community and the team came together. They solved all of the issues. They hired better developers with the treasury fund, right? They had capital in the treasury they could use to make the project better instead of just taking it for themselves. Then they deployed MCC 3.0, which is what we have right now. So let me show you the buybacks over here on the left-hand side of the screen. So here you can see the number of buybacks that have been performed so far is 19 in the total amount of $1.25 million. Okay, so they're going to the open market and they're using the Ethereum in their wallets to go ahead and buy MCC tokens. Then they either burn them, completely erasing them from the supply forever, making MCC hyper deflationary, or they actually go ahead and add liquidity on, like I said, PancakeSwap or Uniswap to increase the liquidity. And of course, that will equal more trading volume. More trading volume equals more taxes taken from all of the transactions, buys and sells, meaning more reflections for holders, more money to the treasury wallet that they can go ahead and use and deploy in all these different blockchains to earn yield, right? And all this yield goes to the buybacks. They either lock up their tokens for liquidity for 100 years or burn them completely, which of course will make the value of the token actually increase. So you're getting the reflections and the appreciation of the MCC token asset all in one, all right? So this is a bit of a lot to talk about. It may be complex. So with that being said, let's go ahead and go to the MCC Medium, which describes in detail everything that I pretty much said, but of course they break it down and tell you all the facts and the numbers as well. All right. And also go ahead and follow MCC on Twitter, all right? This project is only a few months old, right? I believe it came out in November. Like I said, they had a few hiccups with their contracts when they first went live, but the community and the developers did come together to actually fix it. All right, so follow MCC on Twitter. Now let's get into basically the long-term plans. This is an article from about 2 weeks ago on December 30th, 2021. So MCC, the mission statement for multi-chain capital, they want to provide a simple way for DeFi users to benefit from yield farming investments by doing the heavy lifting, right? It's a farming as a service. This is DeFi 3.0. We don't even have to do anything. All we need to buy is a farming as a service token and let them do everything for us, and we get rewards. All right, so by doing the heavy lifting in terms of bridging, farming, and investing, MCC returns yields only available in other layer 1 chains, Phantom, Polygon, etc. We went through those, to users on Ethereum. By holding MCC, the users earn both reflections and a future share of profits from the farming investment portfolio. All right, and some key announcements. So there's over 14,800 holders, almost 15,000 holders. We can see right here, this is big. 35.7% of MCC burned to the black hole via hyperdeflationary measurements. I actually didn't describe this graphic over here. The supply mechanics over here for MCC, you can see their circulating supply is 2.19 trillion and they've burned 1.5 trillion coins, right? So that is very big. They've burned about 41% of the overall supply of MCC so far, and this is going to continue, making it hyper deflationary, which of course, supply and demand, if there's less supply and people want to buy it, that's of course going to increase the price. And you can see the market cap of MCC right now as well as $127 million. Price is a fraction of a penny, and it's down quite a bit from the all-time high. I mean, we'll be taking a look at the price chart in a little bit. Nonetheless, let's continue on with our focus on basically what exactly MCC is and how they're deploying their capital to farm as a service for us, the users. And full disclaimer, I do own MCC in my own portfolio, all right? So let's continue on with the video. So they also did go ahead and move 10% of the funds to a multi-sig wallet. This means that one developer can't just run off with all the money in their wallets, right? Whether that's the treasury or their marketing wallet, etc. Nobody can just run off because 10% of it is now moved into a multi-sig wallet. They did get audited by CerTic, all right? So the contract, in theory, can no longer be exploited. They lock liquidity for 100 years, all right? So this showcases long-term commitment in the project by the developers. And this obviously is crucial for the community. If we're going to invest our money into a project, we want to make sure that the liquidity is locked and nobody can just take it out right away. That's mercenary liquidity, DeFi 1.0 activities right there. We don't want to see that. This is DeFi 3.0 now. Hit that like button if you agree. And now moving on, we can see that they say over the course of the project, multi-chain capital has evolved in numerous areas to meet community needs and improve the long-term viability of the project, right? So they took a lot of criticism, they took a lot of heat when their 1.0 contract and 2.0 contracts came out. And now they're actually solving all the problems, patching the holes, fixing the holes, and making this an actually strong, legit project that in theory can stand the test of time now. All right, so they're evolving the tokenomics. They took MCC from inflationary to a fixed supply, and then now it's hyper deflationary. 41% of the supply is already burned. This is only going to continue, right? Security evolution. They have a multi-sig wallets and contract audits, and rewards evolution. So reflections, buybacks, and future products. All right, so updates more to come. You can see the tokenomics evolution. So 1.0 was inflationary. 2.0 they had the fixed supply, but it was still it wasn't a good contract. There was a lot of stuff wrong with it. So they hired better developers, the Moontography guy from OKLG, and he made version 3.0. Now it's hyper deflationary, which in theory should cause an MCC supply shock. All right, so the tokenomics and multi-chain capital have evolved over time to meet the demands of the market. So they had inflation in the beginning. This was not suitable in the long run. Version 2.0 had a fixed supply. However, there were issues in deployment that required us to upgrade to version 3. And now finally with version 3, they're focused on making the contract last long term and actively reducing circulating supply over the long term by introducing hyperdeflation. Also, they have multi-sig wallets farming on different chains, right? So like I said, that's more secure. Not one single point of failure, not one single person can go into that wallet and withdraw. Multiple parties need to confirm the transaction with multi-sig. So that's encouraging. We like to see that. Now, moving on, we can see, so the focus on decentralization, exactly what I just said, multi-sig wallets, no central point of failure or dependence. So for the funds in the Ethereum network, 10% of the total, they are currently in a multi-sig wallet controlled by the multi-chain capital team and advisors. Like I said, these projects are largely dependent on the team behind them. If the team decides to do some shady business, well then guess what? All the investors are out of luck. But I've personally seen projects where there's the main developer, or the creator, the CEO of the token does a very good job managing it, right? I'll give a shout out to Richard Hart with Hex. Nonetheless, he's done a very good job managing the project, and he's made a lot of people a lot of money, and now he's launching some other stuff as well. Regardless, let's go ahead and continue. So for the funds on other networks, Phantom, Matic, the funds are invested directly into DeFi farming or DeFi bank sectors, which currently can have complex interactions in a multi-sig wallet. So that's why it's not multi-sig yet. So they're exploring different options to make that multi-sig. Got audited by CerTic. So the locked duration of liquidity is now 100 years. And they have a total of $10.4 million of liquidity on ETH and Binance Smart Chain with BNB. All right, now with the reflections, like we talked about, 8% buy tax. So if I'm going to buy $100,000 worth of MCC, 8,000 of that will actually go to every token holder in the form of reflections. And then on the sell tax, we can see right here that 8%, it was 10%, goes to the treasury and will be used for buybacks, marketing, and development of future projects as well. So when somebody buys MCC, us, the holders, get rewarded. When somebody sells, the team's wallets get filled up and they use that to farm, make more money with DeFi, or they can burn it, or they can do buybacks and use those buybacks for liquidity, then lock that liquidity for 100 years. So in theory, this should be a success. This is not financial advice, of course, but it's built out. They did a lot of thinking to make it right. They went through multiple versions, multiple drafts, Now we have MCC 3.0. So we can also see right here in regards to the 8% tax from 10%, will you receive less reflections? So they're hoping with the higher trading volumes, with the less buying tax, this will in turn result in even more reflections for the holders. All right, now let's get into how they're actually using this money to farm in DeFi. All right. So like we said, they're on Phantom, AVAX, Binance Smart Chain, Matic, and ETH. So they're using safe stablecoin returns. They're farming with little to no impermanent loss, and they're compounding returns where possible. So for the first area, which is safe stablecoin returns, we can read right here. The major focus here for MCC is to ensure that the stablecoins we invest in are highly liquid and highly backed by assets or collateral. So they're using USDC DAI and Tether USDT. And then they put these stablecoins into interest-bearing or farming opportunities where the APY ranges from 7% to 24%. So they're using Scream on Phantom with $1.2 million. And this is earning 7% APY. Phantom and Curve earning interest as well. And they're earning the Scream token, which is currently trading at around $40. All right, so that's what they're doing on Phantom. Now they're also using Curve on Phantom, so they have about 700 grand in Curve, earning trading fees as well as Phantom and Curve tokens. So MCC currently owns 1.1% of the Curve 2 pool on Phantom. Also using Spooky Swap, about 200K in the USDC MyPair liquidity pool, earning 24.3% APY, and they're getting Boo tokens as well. Basically what they're doing here is DeFi 1.0 activities, very similar to adding liquidity on Uniswap over here, right? Now their second area of focus is farming assets with small impermanent loss. So for this, they have about $100,000 in Phantom and Tomb Finance. Tomb Finance, by the way, absolutely crushing it nonetheless. So this is a liquidity position with two assets which remain stable in price. Tomb is designed to be pegged to Phantom, so both assets remain stable in value, reducing impermanent loss. All right, so if you didn't already know about impermanent loss, basically if you add liquidity to a token pair, let's say you add Ethereum and USDC, price of Ethereum goes up, you're going to end up with a lot less Ethereum and a lot more USDC from the funds that you added to that liquidity pool. Short summary of how impermanent loss works. Basically, you want the assets, they want to remain the same value in price of when you added them. If one goes up and one goes down, you're going to get a lot more of the tokens of the worst performing assets. All right, so keep that in mind with DeFi and impermanent loss. All right, so with this, they're earning 155% APY with over 22 grand in profit thus far. Now, their third area of interest is they are reinvesting in compounding investments. So for this, they are earning those Boo tokens, right? And then they can stake that and earn additional FTM Phantom tokens. All right, so they have Scream staked on Tarot, and Tarot is a project which enables users to leverage their liquidity positions. So they have taken the Scream and deposited it into the supply section, earning 62% APY over there on Scream. These are some summaries of basically how they're deploying the capital to yield farming as a service for us users. They then go ahead and take the profits from farming and, like we talked about, either buy back, add liquidity, burn, or just put them in the marketing and developer treasury wallets to use for future deployments. All right, so you make money on the buy side. When somebody buys, you get the reflection on the sell side. The team gets the money to then go ahead and farm and further develop the project. Now, before we wrap the video up, let's go ahead and take a look at the MCC price chart. And like I said, this is available on Uniswap or PancakeSwap on their respective networks, Binance Smart Chain or Ethereum. I do tend to look at the Ethereum chart because it is more liquid, it has higher market cap, and it was originally deployed on Ethereum before it did get migrated with the bridge over to the Binance Smart Chain on PancakeSwap. So we can see on the daily price chart that we do have these previous all-time high levels over here. These were used as resistance, currently being used as support. All right, so price currently tested the support level 2 times over here. This is where you want to be a buyer, basically using this one demand zone. This is a rally-based rally as well. So we can see that this is a pretty key zone, and to keep it very simple, you want to be a buyer in demand and a seller in supply, okay? So I'm bullish on this asset. Like I said, I do hold it in my own portfolio right now. So with that being said, I do expect price to continue rising. I wouldn't hold it if I didn't think it was going to go up, right? With that being said, not financial advice by any means. Do your own research, do your own due diligence before you invest into any project. Now, you want to be a buyer over here in demand. If we do actually go ahead and break these lows over here, which we have very uncertain market conditions, but I think that MCC can actually be an outlier and outperform the market. Nonetheless, we do have some other areas that I am looking at. One over here, 0.004111. All right. I see that as the top of another demand level. And then we do have some other areas down here as well that I have outlined. So be on the lookout. If you're bullish on MCC, I would wait for dips to actually add to your stack, or you can take the trusty old dollar cost average approach and get the best average price over a given period of time. Nonetheless, with something like this, you're not going to want to actively trade it because like we talked about, there's an 8% buy tax and an 8% sell tax. So if you're constantly hopping in and out, you're going to get hit with a lot of taxes and actually lose a lot of your gains from these taxes. So this is more of a buy, hold, and accumulate for me personally. You need to come up with your own strategy of whether or not you're going to invest in the first place and then how you go about managing that investment after you are already positioned. So DeFi 3.0 introduced farming as a service, which allows investors like you and I to buy into one of these DeFi 3.0 protocol tokens. In the video, we used MCC as the example, but there are many out there that do exist. All users, investors have to do is buy the token, hold it in their wallet, and they passively earn yield with reflections. And then the team gets the sell tax, which on MCC is 8%. They then deploy that capital on multiple different blockchains to earn yield to increase the value of the treasury, which increases the value of the project overall, which of course is great for the price action. So in theory, the value of the MCC token or any DeFi 3.0 token appreciates, and you get the reflections, which of course makes for happy investors. So if you did enjoy this video, make sure you let me know by leaving a like and a comment down below. And if you are new to Crypto Empire, go ahead right now and smash that subscribe button down below and turn on all bell notifications so you don't miss any future videos. And my name is Connor from Crypto Empire, and I will see you in the next video.